Outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And quite a bit has shifted a bit over the past couple of days with respect to the bond market and just how that has affected the rest of the market. So let's go ahead and take a look at that. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at the major equity indices. There's not a whole lot that has changed there from what we spoke about here last week, but the fixed income markets, there have been some sizable shifts across the board. And that has influences both on interest rates, around commodities, as well as some of the sectors. So we're going to take a look at all of that and see how they have moved in relation to that fixed income shift that we have seen. And we'll take a look at some of the economic indicators, the job numbers from last week. We'll dissect that and see how that has affected our views, and then share with you some of our ideas as far as how we're looking at this type of market. But the primary question that I want to help investors answer from today's session is a clear understanding as to, are the rising treasury yields that we're starting to see a threat to the rally that we have in the equity markets? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my economic charts, and the ways that I'm looking at the market in this current environment to find opportunities and ideas. So when we look at the S&P 500, we have on the longer term chart a very clear uptrend. There's no doubt about that, a very orderly uptrend. Same thing on the daily chart here as well. But I do want to point out here, over the past couple of weeks or so, similar to what we've seen here prior, we've seen a bit of a stall on both the price and momentum. And we've seen higher highs in price no longer being confirmed by higher highs in momentum on both short-term and longer-term charts. And this is really where we need to be on watch for potential pullbacks here. Now, these pullbacks don't have to be necessarily very deep pullbacks. They're likely sometimes very shallow pullbacks before they continue moving higher. And then once we test these shallow pullbacks here, we want to just keep it on watch to see if there's a bigger pullback. So right now, we're on watch for a potential pullback because we have seen price and momentum stall on major indices like the S&P 500, as well as on the NASDAQ 100. Higher highs in price no longer being confirmed by highs in momentum. And we see on the longer term chart, higher highs in price no longer being confirmed by higher highs in momentum. So you have a confirmation, you have a combination of the S&P and the NASDAQ, both exhibiting very similar price action here, while other indices like the Russell 2000 have basically made no progress since last year or the beginning of this year. If you look at the Russell 2000, we're trading at the exact same price we were trading back here in January and February. And even over the past couple of weeks, as the S&P and NASDAQ pushed to new all-time highs, the Russell 2000 failed to even get back towards its recent all-time highs. It's really lacking a strong amount of momentum at all. And the price action looks fairly weak and potentially revisit these recent lows and potentially at watch of a break below those lows as we start to now come across some major long-term moving averages and starting to test those prices as well. And then if you look at the Dow Jones Industrial Index, this is the equal weight S&P 500 index. As you can see, basically since the May 5th highs, we have made almost no progress in terms of price. So during that time, as you can see, momentum continues to decline here. We have made one attempt to break out higher here over the past couple of weeks. It is still technically holding those levels, but it's not the price action and momentum that we typically would like to see on a breakout, where we see kind of a strong amount of volume and a strong amount of momentum through that. We're just not seeing it both on the RSP as well as on the Dow Jones Industrial Index, which is also, again, back towards that May 5th high level and has failed to break out higher here when we look at the Dow Jones. So across the board, especially when you look at the equal weight indices, the RSP and the Dow Jones Industrial Index, which is a price weighted index, actually not quite the same as an equal weighted index, but those are the ones that have failed to break out higher. And this is just showing us a lack of market breadth in these types of equity markets here at the moment. So a lack of price action confirming higher highs, a lack of momentum is really concerning at the moment for equities. However, when you look at bond markets, this is really where the bond markets have been on a very strong tear here over the past couple of months. Just on Friday, this is when we started to see some of that rally crack. We've seen a breakdown here below this long-term support level, or trend line rather, and now is starting to test long-term moving averages and potentially continuing lower here. And we're seeing it not only in the treasury bonds, we're also seeing in corporate bonds. If you look at LQD, investment grade bonds, also strong rally here over the past couple of months, started to really start falling apart here over the past couple of days. And the only one that's still holding on at the moment is high yield, HYG. HYG, while did not rally very much over the past couple of months, also has not fallen very much over the past couple of months, but also at risk of testing some major support levels and major resistance levels. Major support levels and major moving averages that, if we break below that, can spell some further downside here for bonds. And that obviously has a very large impact here on treasury yields. So treasury yields finding a bit of a bottom here around 115 basis points over the past few weeks, have now started to climb back into the 130 range, 133 basis points as of right now. And the question is whether this starts to be more of a range bound and finding some consolidation between 130, 115 basis points, or if we start to see this continue to climb. So this is an important level for us to pay attention to see which one of these two scenarios starts to play out. If we look at the bond prices, there certainly seems to be far more I would say, opportunities for bonds to continue to fall. That would certainly put rising yields back into play. Rising yields is going to be a threat to the equity markets, especially the higher beta tech names. So for those of you that are invested in some of those higher beta tech names, this is something that you really have to pay attention to right now, as this is going to have some major ramifications as to the holdings that you have within equities. And then when we look at the dollar index has started to test this recent high, 93, which we've made multiple attempts at 93 to break out higher, has failed. And this is starting to push higher here. And if we see 93, this is a major level that has been in place for quite some time. And now we're starting to push higher here, potentially for the US dollar. And that has, ramifications for a lot of commodities, such as gold. Gold recently finding some support around 164, which multiple times after testing it. But finally, we broke below that here yesterday. This is going to put 157.5 support back into play here. Now, gold is severely oversold just in the past 4 sessions. So you may see a bit of a pullback here, a bit of a bounce, a dead cat bounce, if you would, before we head back towards 157.5. But those are some major support levels here. And as you can see, gold has been in a long-term downtrend here. And this is simply just continuing that downtrend. But 157.5 is a major support level. If we break below that level, which you can see also corresponds to the long-term moving average for the long-term chart, that certainly puts gold at a much, much lower level if we break below those levels. So these are some very key levels to start paying attention to here for gold. Crude so far has found a little bit of support here around 66 or so. 66 has been a major support and resistance level for quite some time. If we break below the 66, that would be concerning to me to head back into the $58 level here or so. So you have to pay attention to here for commodities, because we're starting to see some potential support levels broken, and some of them have already been broken. Crude so far still holding 66. There is some concern that the Delta variant is going to continue to dent demand here, while we've already increased supply before the Delta variant came on. So that could have some shifts in terms of the balance for the supply and demand here for oil. So oil, definitely one to pay attention to. And also, it's not just commodities, but currencies, FXE, Eurodollar. Eurodollar 110 or so on FXE has been a major support and resistance level since before the pandemic, is starting to get tested here to the downside. If we look at the shorter term charts, I would say 110 has already been broken, and we're likely headed significantly lower here. This would target 107.5 here to the downside for Euro. So this sell-off we've seen here over the past couple of days in bonds, major ramifications for a lot of different markets, currencies, commodities. So and including equities as well. So it's important to understand these shifts in the markets and be able to know how to track them so that you can see how they're playing out. And the one thing that we've been talking about over the past 8 or 9 weeks or so is the fact that there's been a lack of sector rotation, and that's not particularly healthy for the market to not have any rotation. But last week, I talked about the fact that rotation was starting to come back, and we're continuing to see that here this week. So some of the sectors that are in the leading are sectors that we have not seen in the leading category for a long time, like materials, utilities, healthcare. Healthcare has been there for a while, and also financials making a very strong move here towards leading. And then the ones that are weakening and lagging are the ones that we have largely seen as leaders: technology, real estate, consumer discretionary, consumer communications. Those are the sectors that are weakening or lagging. Those are the sectors that have been strong for quite some time. So this is constructive largely. Industrials, real estate, staples, also fairly weak. And then you have energy here that has made this very big round turn here, but it's starting to lose a little bit of momentum here. So we'll have to watch energy here, especially as it starts to test those major support levels. A potential break below those support levels, I certainly think, would put the energy rally here at risk. And energy largely is still very far behind the rest of the market here at the moment, both in relative strength, but it is a little stronger here in terms of momentum. So when we dive into the actual sectors, there's a few that I think are worth paying attention to. One, overall, rising interest rates, not particularly strong for equities, but it is particularly strong for one segment of the market, which are financials. And what we have seen is that financials, XLF, has broken above this base that it's formed here between 35 and 37. The fact that it broke out above this level here a couple of days ago here last Friday was part of why we had the long Wells Fargo's trade. And this puts 138, which is the all-time highs, potentially in as the last resistance level before financials breaks out significantly higher. So if we see higher interest rates, that's going to put support here for financials. So out of all of the sectors, the one that benefits the most from this current market environment that we're in, especially if it continues in this direction, is going to be XLF, the financials. The other one that has started to form some nice price action here is materials. A similar price action to financials. It hasn't broke out to the same degree in terms of momentum, but price has managed to form a bit of a base here above this $83 resistance level, and has formed this and found some support level, some support here around 83 or so. That does look constructive for materials to potentially rise up to that $89 all-time high, especially if we look at the infrastructure bill. That's going to provide some support here for both industrials and materials. This certainly has some potential opportunities here for XLB here as well. And the one that we really want to watch here is consumer discretionary. We've seen consumer discretionary fall back into that lagging category or weak lagging category, but it hasn't broken on price action yet. So this is one that I'm not bearish on, but it is one that I am watching very closely for a potential break below some small support levels here, or if it starts to break below 174 or so, that's when we can start to see some potential downside here for consumer discretionary. Not there yet, but as you can see, significant higher highs in price, lower highs in momentum certainly points us back towards at least towards the bottom end of that channel here. And if it breaks below that channel, that's when we can see some further downside. But right now, at least looking for that return back towards the bottom end of the channel. But consumer discretionary has lacked price action, has lacked momentum here over the past couple of weeks, and is certainly at watch of potentially losing that the strength that we've seen here from consumer discretionary. So if we shift gears a little bit here to the economic side of things, last Friday, non-farm payrolls came out better than expected, 943,000 jobs added versus the expected 870. So a beat, but not a sizable beat per se, especially in the shape of the recovery or where we are in the recovery here right now. And as you can see, most of that recovery in terms of jobs were added in two segments: state and local local government, and leisure and hospitality. Leisure and hospitality, certainly great to see. State and local, also good to see. It gives us a sense for, things are returning a little bit back closer to normal. This is for July. We'll have to see if August becomes a little slower, especially as the Delta variant may have some impact here. So this is one that we have to watch very closely. But so far, July still on pace or back into what is a relatively strong recovery here from the jobs perspective. But the one thing I will point out here is that what's climbing even faster than jobs right now is job openings. The survey was 9.2, came in at 10.07. So we've seen a continued acceleration of job openings. So while job growth is strong, it's not accelerating the same way that job openings are. So this is continuing that debate that we've been talking about a month ago, actually, a little bit more than a month ago, with regards to whether or not the inflationary concerns that we have are more transitory or permanent. And this wage side of the equation still remains extremely stretched. We're still continuing to see wages rise across many industries, especially leisure and hospitality. The average wage is up to about $16 and $16.50, and it was about 14 and a quarter before the pandemic. And this continues to climb. And this is something that we have to watch here, because the other half of the equation with respect to inflation, such as consumer goods, when we look at commodity prices and starting to see those tumble, that certainly solves some of that and eases that, especially if crude price starts to come down here as well. But the wage side of things, the job side of things, the supply is actually what's constricting the recovery right now. There's not enough human beings ready to fill these jobs that are out there and where employers are looking to hire. That is a concern in terms of the shape of the recovery or the speed of the recovery when there's not enough supply for the demand for these job openings. But the one thing that I do think is encouraging here is what we're starting to see is credit card utilization start to climb. This speaks to the confidence that consumers generally have as people get back to work, as people have income coming in, they feel more confident in their ability to spend. Well, we're starting to see consumer use of credit cards start to stabilize and climb here over the past couple of months. So this is starting to see some encouragement in terms of how consumers are feeling more confident about this recovery. There was a lot of people that were still unsure about this recovery in the first quarter, even in the second quarter. Now, as we enter into the third quarter, we're starting to see people have more confidence here. So overall, the economic recovery very much intact, very strong. There's still a few things that are constraining the recovery, but overall, on balance, looking very strong. So as we look for opportunities here in this market, we have to be considerate of all the things that we showed you here today, especially in that change in shift in bonds, because that could have some sizable shifts in terms of where there's going to be opportunities within the equity markets. So like I said, one of the few segments of the market that responds well to a higher interest rate environment are going to be the financial institutions that are very sensitive to a rise in interest rates. So specifically KRE, the regional bank ETF, regional banks tend to be very sensitive. Finding the $64 support level here for multiple months before breaking below it recently, managed to climb back above the $64 level. And that's where I think we're headed back to around the $72 all-time high. If we can break above 72, that would certainly put this in a much larger bullish, I would say, phase here for KRE. When it broke out here above 46, it rallied all the way up to about 72 or so, and then consolidated here for the past couple of months. It hasn't broken out just yet, right? But this is one that we're watching as a consolidation pattern, which is typical. After a large breakout, you consolidate for quite some time before they continue moving higher here. And this is certainly looking a little bit more constructive here for this to continue back up to 72 and then potentially breaking out even further. But this is kind of the first step towards that. And then when we look at some of the names that have been very strong during lockdown, and as we start to ease and as we start to reopen, I started to see some that momentum shift to the downside. Etsy certainly falls into that category here, and Etsy recently, I would say the 185, 190 level has been a major support and resistance level that we have to pay attention to. After releasing earnings here a couple of days ago, which has been a strong move here, has failed to break higher here and is now back below 190. And I think this, especially when it's back below the long-term moving average, starts to put this at risk, especially since the longer term and daily momentum has started to shift negative here. This is really at risk of potentially a significant move here to the downside for Etsy. So as you look for opportunities here in this market, you're going to see both long and short opportunities, but especially in a rising interest rate environment, you're going to have potentially more short opportunities than you do here to the long side. And then especially as commodity prices continue to collapse, such as gold, some of the mining companies like Newmont Mining, one that I'm paying attention to here right now, has completed what I would call like a head and shoulders pattern. You have just recently broken below the neckline of that head and shoulders pattern, and this projects potentially down to about 54, 54 and a half or so here, the downside for Newmont Mining. So looking at gold, looking at some of the gold miners, these gold miners, remember, these are fairly leveraged balance sheets, these gold miners. And when you have a collapse in gold pricing, these stocks are kind of play a bit of a leverage bet, if you will, on gold. So we may see some some increased volatility on some of these names, especially if you look at a longer term chart here. These stocks tend to just be range bound in the long run. So as we start to see gold price come under pressure, these are likely going to retest these support levels here. If we break below those support levels, that certainly would put significantly more downside here. But for now, I'm projecting just down to about 54, 54 and a half or so on this completion of what looks like a bit of a head and shoulders pattern here on a stock like Newmont Mining. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you an understanding as to what is moving in the current market, how that shifts our views across the different asset classes, from bonds to commodities to equities. And then within equities, how do you look for opportunities in a rising interest rate environment? What do you look for and what do you stay away from? Hopefully this gives you some idea as far as what to start watching and paying attention to, especially for those of you that may be invested in some of those higher beta tech sectors and how you might want to shift your portfolio from that. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday for our options education session, where I have a very, very important session that I want to talk to investors about, because I think it's arguably one of the most important lessons that you have to learn as a trader. So with that, thank you so much. Have a great trading day, and I'll see you guys on Thursday.